Hello and welcome to 2020's September Advanced Projections Report. Here's our forecast reviews for the month. We said last month that our expectations for the remainder of the summer through July and August were for U.S. COVID-19 cases to double, from 3.26 million at that time to more than 6.5 million, with fatalities pushing through 250,000, perhaps to 300,000. As of September 7th, U.S. cases reached just over 6.3 million, and somewhat more fortunately, fatalities have only gotten to just under 190,000. Effects on transmission and mortality are anticipated to move higher again due to openings of schools, colleges, and universities, as well as the Labor Day holiday weekend. Both case numbers and fatalities are likely to double again between now and the end of the year. Globally, we expected cases to reach 25 plus million from 19 million at the beginning of August. The expected increase of 6 million cases turns out to be 8.7 million, almost 50% higher, to a total of 26.7 million. But again, fatalities did not accelerate as rapidly, moving from 713,000 to 900,000, a one-third smaller increase than we anticipated. Globally, with almost 21 million resolved cases where patients have either recovered or died, the fatality rate is still well above 4%, and global fatalities will exceed 1 million during September. India is having a rapidly increasing number of cases, and due to widespread crowded living areas and impoverishment, will have a very difficult time controlling their outbreak and the consequential economic effects. With a population 4 times the size of the USA's, it is very likely they will have the globe's highest case fatality counts within 4 to 7 weeks. We repeat here, there is no doubt that this is a dire situation and it demands our responsible attention from many aspects. Negative economic consequences such as reduced activity and higher regional unemployment will be reignited in the coming quarters, and we will have to hope for a renewed situational control effort from governments, as well as further injections of funds into the hands of those who require financial assistance. Yet politicians argue, defer, delay, and cannot agree here, causing further damage. Happy talk about a safe and efficacious vaccine which would arrive in time and in sufficient quantities to immunize a large portion of the global population, or even a national one, are so far falling into the category of fairy tales. Why? Because normal vaccine development times are on the order of 10 years, and the hopes of doing it in just 10% of that time are counting on absolutely everything working perfectly. So we should be more realistic in our expectations and presume that under the best of circumstances, it will be mid-2021 or later before large numbers of people can be given one of the vaccines currently under trial. Now for the current economic environment. In August, unemployment levels declined again somewhat to a national level of 8.4%, with most of those returning to work having been temporarily furloughed from their jobs in mostly service industries. More of the remaining temporary layoffs have become permanent ones, and the hardest hit industries will have begun to another round of permanent layoffs. We anticipate that during this fall, return to work gains will flatten further as outdoor seasonal work hours decline. Anticipating additional issues arising with educational reopenings and a fresh set of holiday-related infections in the ensuing weeks, we expect unemployment will slowly move back up, returning to the 11 to 12% area, where it will stubbornly remain far into 2021. With winter weather already arriving in some locations and newer, cooler temperatures which are not as conducive to outdoor dining, many establishments for dining and entertainment will face new pressures to control coronavirus transmission indoors within their facilities. and will certainly face operations at substantially reduced capacities and sales volumes. We'll have to wait for further developments with the arrival of autumn. Equities markets appear to have peaked, at least temporarily, at this time. Anecdotally, we have received inquiries about choosing stocks to purchase within these very frothy markets. One inquiry, which we strongly advised against, has declined by 25% in just 1 week. There are a lot of neophytes and quick buck opportunists who are not investing for the long run at this time, but rather trying to make significant gains in a matter of just days or a few weeks. That is one sure sign of a market bubble, which we are going to discuss forthwith. Now, for our individual indicator information, we're going to begin with the APSI indicator. Our indicator looks at the relationship between current month-end S&P 500 equity closes and the ones from 4 months back, as well as comparisons to a set of long-term growth rates. For September, the APSI has remained yellow, with the index closing out the month just a few points below our warning level of 3506. We knew that the red zone was soon to be pierced, and the index moved into it on September 1st and 2nd, exceeding our warning level for overheated by 80 points. But since then, in the ensuing 3 trading days, which have all been down, a decline of 250 points along with some well-known financial figures started to talk about an actual market bubble. One thing every serious investor should realize is that no big name is going to talk about a bubble until they have actually pulled out of the markets. In August, employment happy talk continued to fuel the equities markets. Investors continued to grasp at these straws of hope for a miraculous V-shaped recovery and a return to normalcy. Markets did indeed push back to their old February highs based on this kind of speculation, but we have been expecting more fundamental and more sobering information is going to be realized over the coming months, eventually putting a pin in this bubble of false hope, in very similar fashion to late 2007 through 2008. The 3-day pullback for the S&P represents a 7% downward move. Between public comments and this rapid downdraft, we may have just seen the beginning of the end for this bubble. It will take another month or two before we know for sure. We're providing a chart that illustrates the onset of this perfect storm of 4 conditions that signal the formation and possible end of the market bubble. The 4 telltale situations shown in the chart are: 1, when the index value exceeds extreme long-term growth rates; 2, when the price-earnings ratios of the index start to degrade by moving up rapidly from value ranges to bubble and collapse range; 3, when the index exceeds its nominal share of the GDP; and a unique 4th situation. Now, in the chart, which of course you have to look at within our report or on the website, we'll explain that the current bubble that is shown at the right end of the chart, the S&P 500 index entered extreme growth territory for just a couple of days at the beginning of 2020's September. Whether or not it returns there after the very recent 7% correction is only a matter for speculation at the moment. That number again is the value will have to exceed 3506 at the beginning of the month and about 3520 by the end of the month. The index's aggregate PE ratio has been in the red now for 2 months as share prices moved up into record territories while earnings have been severely impacted by the very real recession. PE ratios have been one of the classic yardsticks by which traditional and highly successful value investors have measured the real value of stocks. When this number gets too large for the category, it is bound to correct backwards if earnings decline further. Due to the decade-long low interest rate policies of the Fed, the index has exceeded a nominal share of the GDP for several years now. Why? Because investors were almost forced to turn to the stock markets to gain reasonable returns on their money, as cash could no longer earn significant interest. So the markets grew much faster than the underlying economy. It is quite inevitable that the balance must eventually be restored, with the index correcting to under the proportional GDP value, which itself is still declining due to the recession. Now for the unique element number 4 in our current situation. This market bubble is already occurring within a recession that has been declared and generally recognized. So the historically rapid GDP collapse has so far been ignored by those who have driven up stock prices to and through irrational exuberance territory. This is a grander version of what happened with dot-com stocks 20 years ago and with real estate a dozen years ago. Uninformed speculations outpaced rational investment, creating bubbles in both instances, which eventually collapsed when speculative capital dried up. We will be watching market performance and growing margin borrowing levels, our favorite tool for tracking speculative excess. The last peaks in margin borrowing showed up before the 2 large corrections of 2018, both of which we predicted. Our expectations for the eventual bottom for the S&P remains in the 1,200 to 1,500 range, but could potentially be even lower. Other status indicators are about the Federal Reserve's weekly aggregate measure of economic stability, which has returned to just within a position of relative safety. But the Fed itself has accepted the NBER declaration of recession within their data sets. Therefore, our AP-FD indicator for this report remains red, now for 5 straight months. Over the past 6 recessions, this indicator has been highly reliable in its ability to confirm that a recession is on the way, or like now, actually in progress. The AP-MS money supply indicator remains solidly green as the Fed continues to pump money into the money supply at record levels, supporting the federal government's financial stimulus package outlays that will be totaling well over $2 trillion, with even more being dangled at us by Congress. The Fed continues to buy corporate debt and also continues to warn Congress that the bottom layers of the economy are suffering, and the whole economy will suffer more if no new and significant stimulus is injected there. Fed Chairman Powell claims that their actions have provided liquidity and stability in the financial markets, but these large infusions of cash are still not going to places where they will be rapidly loaned and spent, and hence will not provide the necessary velocity of money to truly help drive the GDP upward towards recovery. Earlier in the summer, we said that when the Fed finally reports GDP and the velocity of money for the second quarter, we expected precipitous declines in both. This is exactly what happened when those numbers were released just at the end of July. The velocity of money dropped from 1.347 to a corrected value of 1.102, where our internal projection was to 1.100. So we were essentially spot on with that projection. The GDP rate has dropped to $19.4 trillion per year from the $21.7 trillion per year established 6 months ago. Look for further declines in both GDP and the velocity of money. These are sure harbingers of a deep and protracted recession. Some speculation had moved into precious metals as all were showing upward price movements at surprising rates of increase. Gold spent all of its time above $1,900 an ounce in August, down from a temporary push above $2,000, penetrating that mark for the first time in history, and breaking the old record set 8 years ago. We just said in July that we expected decade-old highs for gold and silver over the next couple of years, but gold just blew through that expectation in only 1 month. There will likely be some pullbacks in precious metals along with the equity market declines as speculators voluntarily or involuntarily sell off. Our internal target rate for silver was $30 to $40 per ounce, and it appeared that the lower number would be reached in August as silver had doubled from $14 in March. That did not occur, but silver held solidly above $26 after a one-day retreat from the $28 region. Our targets for gold have been adjusted upward to $3,000 to $3,500 per ounce, and silver at $40 to $50 per ounce, again within a couple of years. Parabolic moves upward in these prices, as we recently saw with rhodium in early 2020, are good profit-taking opportunities. Month-end pricing for gold and rhodium still puts our AP/PM precious metal indicator well into the red for the time being. Rhodium continued reflecting some speculative upturn for the time being, but prices will eventually move down relative to gold next year. The July leading economic indicators from the Conference Board again improved slightly, but for this report, our AP/LI indicator remains solidly red. We expect declining LEIs to return within the next few months. Due to the collapsed yield curve, our APYC indicator remains yellow for June. All Treasury yields moved up slightly, with the 3-month yield rising to 0.11% from 0.09%. The 5-year up from 0.21% to 0.28%, and the 10-year from 0.55% to 0.72%. These are all indicative of tentative moves from safety and an accompanying bump in demand for loans in all areas outside of the housing market. Some analysts say these continuing low rates, along with the huge drop in the velocity of money, presages another big hit to equities now ahead. We shall see. Timing the next big leg down is a risky business. We know it will happen, but not precisely when. Something will have to spook the markets further, and a large wave of selling would probably do the trick. So in summary, only one of our 6 indicators is in green territory. We are keeping our probability of a near-term recession at 100%, because of course we're right in the middle of it. We calculated that the actual onset of a recession had already begun almost 6 months ago, a fact which was then confirmed by the NBER in June, and it became officially acknowledged by the Federal Reserve later in the summer with the adoption of NBER's declaration within its own data sets. Further modifications to this scenario will depend on what happens in the days and weeks ahead, but the events are highly unlikely to change the outcome of what has already been set in motion. Reviewing the events leading up to the Great Recession, there was a brief rebound before the serious declines of late 2008 within the context of an unbelievably risky economy, just as we are facing now. So our final notes, and yes, we've said these things before, they are, as of this writing, losses from the S&P's 500 peak of 33.93 are only about 2%. But we think that they are eventually going to be much more severe than that, reaching down 55 to 65%, down into the 1,200 to 1,500 range, whenever the bottom is going to finally be put in, probably in the depths of the recession late this year or into 2021. If you are not risk tolerant over the long term, or cannot wait the usual 5 to 6 years of recovery time that equity indexes typically take to get back to break even, you should not have any raw exposure in the equities markets at this time. It would be best to be on the sidelines and wait for the worst to come and go, waiting to get an all-clear signal from our indicators as to a much safer re-entry point. Current market levels are in bubble territory and are being unsustainably supported by unwarranted optimism and speculation, in our view. Remember, the principles of capital preservation and risk management must underpin every serious investment strategy. Our current economic problems will not go away until COVID is under firm control, rather than still being a heavy drag on the economy as it is now. Speculators and gamblers who lose 50% must follow up with 100% gains to simply break even. If they lose 65%, they must follow up with 200% gains simply to break even. So please, be realistic in your outlook and planning. You will not miss out on anything truly big by being a rational and conservative investor at this time. Thanks for listening, and we hope that you find our newsletter and the financial updates and graphics that we are providing are great news and helpful in your financial pursuits. And also, we invite you to look at our YouTube channel and our Facebook page for further information and some detailed descriptions of events that are happening day by day as supplements to your monthly report from Advanced Projections. Thanks again, and we'll see you in October.